So let's quickly review the interest parity approach to exchange rate determination. We imagine that investors care about the returns to their financial investments in their home currency. That is, if we're people living in the United States, we care about our financial returns in terms of dollars because that's where we're going to spend our money. If we're Mick Jagger and we have 6 different homes around the world, then this simple approach doesn't apply to somebody like him, where he might care about a basket of returns in terms of different currencies. He's diversifying his consumption portfolio. He can consume in France, he can consume in England, he can consume in Japan. Most investors aren't like that. They just consume in one place. So we imagine that they care about the returns to their financial investments in terms of their home currency. So we typically imagine that in markets for financial investments that are very liquid, we have a no-arbitrage condition, which means that you can't easily make profits by borrowing from a low return place and investing in a high return place. So we imagine that arbitrage, large flows of financial capital, equalize returns in different places. If returns were high in one place, everybody would invest in that place and the returns then would fall. So we imagine that returns, for example, in the United States are going to be equal to returns in Europe. We think of investors as choosing between investing in European banks and earning European interest rate, or investing in European bonds and earning an implied return interest rate on the European bonds, and investors choosing to invest in dollar assets. So the interest rate, we imagine then, simplifying even further, the asset's just something that generates an interest rate. The asset in the United States generates a dollar interest rate. The asset in Europe generates a euro interest rate. But of course, if you invest in euro and you care about the return in dollars, you have to take into account that maybe the euro is going to appreciate and there'll be some expected appreciation of the euro. That could be negative, of course, if there's an expected depreciation. So the expected appreciation would then be a negative term that we would subtract from the interest rate in the euro. So writing this down a little more simply, we have the dollar interest rate, the euro interest rate, and then an expression for the expected appreciation of the euro. The EE term there is the expected future exchange rate, the exchange rate that you expect to see maybe a year from now, maybe 3 months from now, that really for our purposes right now we don't need to worry about what the time dimension is here. We could imagine it being an overnight rate, we could imagine it being a 3-month rate, we could imagine it being a 1-year rate. Arbitrage obviously is going to hold very closely for a 1-day rate, an overnight rate. It's going to hold quite well for a 3-month rate. It's going to hold a lot less well for a 1-year rate, where we have to take into account risk a lot more than we are right here. We'll come back to that at the end. So EE is the expected future exchange rate. We can look up in the Wall Street Journal what the expected exchange rate is, and because people transact in futures exchange rates and forward exchange rates, they transact in options to purchase foreign currency a year from now or 3 months from now. So those rates are easily available to us, and we might simply adopt those as our expected future exchange rate. And then E is the current spot exchange rate. So the difference between EE and E is how much the exchange rate is expected to change. When we divide by E, we have the rate of change over the time period. And we're expressing the exchange rate in terms of dollars per euro. So when E goes up, we have more dollars per euro. That's then a depreciation of the dollar and an appreciation of the euro. Let's do a little numerical example here to clarify ideas. Let's suppose that the interest rate in the U.S. is 6%, the interest rate in euro is 4%, and the expected future exchange rate a year from now is $1.1 per euro. So then we plug those numbers into the formula, and we calculate the value of E. Remember, this interest parity condition, or this no-arbitrage condition, is a theory of the determination of the exchange rate. It's saying that the dollar interest rate, the euro interest rate, and the expected future exchange rate together determine the current spot exchange rate. So we have a formula, an equation. It's one that we definitely want to memorize. And we plug in our numbers and we do some algebra. And we end up with our current exchange rate being roughly equal to 1.08. So given that, we notice that U.S. interest rate is higher than the euro interest rate, and the expected future exchange rate is 1.10, and the current exchange rate is 1.08. So the dollar is expected to depreciate over the course of the year. That is, the euro is expected to appreciate over the course of the year. So if you invest in euros, you get a 4% interest rate plus a 2% expected appreciation. Let's see what happens to the exchange rate when the interest rate changes. Suppose the interest rate rises to 0.08 in the U.S. and there's no change in the expected future exchange rate and no change in the euro interest rate. Then we have a new formula. We just plug in the numbers and we solve, and we get the exchange rate equals 1.06. So the rise in U.S. interest rates causes the dollar to appreciate. Before, you had to pay $1.08 for a euro, and now you'll only have to pay $1.06 for a euro. So the dollar appreciates. Notice, however, that the dollar is still expected to depreciate because in the future, the markets and you are expecting the dollar to be $1.10. So the expected appreciation is now bigger. The expected depreciation now of the dollar is 4%. That is, the expected appreciation of the euro is 4%, and that's compensating you for the low interest rate in Europe. So to recap, the interest parity, or the no-arbitrage condition, implies that the dollar interest rate, the euro interest rate, and the expected future exchange rate determine the current spot exchange rate, which I might add then determines net exports, and that's our aggregate demand model, where we have net exports depending on the exchange rate, and we see now that the exchange rate depends on the interest rate. I should note that sometimes we adjust the interest parity formulation to explicitly include a term for a risk premium. So if investing in the euro is risky because the exchange rate in the future is unknown, and therefore there's some possibility that the euro could depreciate as well as the possibility that it could appreciate, then if we're averse to risk, we'd want to subtract some risk premium, 1%, 2%, that is the value to us of holding a risky asset. We want to subtract that from the expected return on the euro. Likewise, we might imagine that engaging in these complex foreign exchange transactions, really it's just the push of a couple buttons, but we might imagine there's some transaction cost to doing that, especially for small investors. So we subtract that transaction cost, which we might express as a percentage of the value of the transaction.